All right, we'll now give you a progress update on Pillar 2. So what is Pillar 2? So Pillar 2 is an OECD measure adopted by over 140 countries and is equally applicable to tens of other major countries as well. What it requires is that affected multinational groups have a minimum effective tax rate of 15% in every jurisdiction in which the group operates. And this is the important bit. Whether or not you have top-up tax to pay, you need to prove your effective tax rate by performing the Pillar 2 calculations and lodging the Pillar 2 forms in the countries which requires them, including Australia, including other jurisdictions as well. So who does Pillar 2 apply to? It broadly applies to groups with a consolidated turnover of euro 750 million or more. So you're focusing on the consolidated turnover. When does Pillar 2 commence in Australia? So the rules broadly commences from 1 January 2024, right? But it's important for you to understand three charging mechanisms. So charging mechanisms are the provisions which allocates and charges top-up tax. So it determines which countries pays the top-up tax. The income inclusion rule and the domestic minimum tax applies from 1 January 2024. The third one is more worrisome. The third one is called the undertax payments rule, and it applies from 1 January 2025. Why is the undertax profits rule more worrisome? It's more worrisome because an Australian entity could potentially be subjected to top-up tax of all other companies in the group outside Australia, whether or not Australia have any interest in those entities. So you in Australia would not know whether the undertax profits rule is triggered. However, your auditors would require evidence that the undertax profits rules have not been triggered. So an analysis would be required from head office. When will the first lodgements be required? So you need to lodge the Pillar 2 forms within 18 months of the end of the first operative year. So most of you here have a December year end. So your first lodgement is 30 June 2026. If you are a June year end, your first lodgement is 31 December 2026. These are the forms which you need to lodge. The first one is a global information return. The global information return contains data for the entire group, the entire multinational group. Now, regardless of whether or not your parent company's jurisdiction has implemented Pillar 2, so for example, China, US, they have not implemented Pillar 2, the GIR form must be lodged. So somebody needs to lodge the GIR. And we have seen cases where Australia has been requested to lodge on behalf of the group. The GIR can be lodged in any country, and the ATO would access the global information return through the information exchange mechanism. So you're familiar with this if you're performing CBC reporting. The other three forms must be lodged in Australia, and I expect if you're foreign headquartered, you'll be requested to assist with this. Karen, attending online. All right, this is I'm covering Pillar 2 at a high level. If you want an in-depth discussion of Pillar 2, you can go to our website, sw-au.com. Under Insights, you should be able to find resources and videos on Pillar 2, or you can go to YouTube and search SW Pillar 2. What are the implications for your financial statements. So the Pillar 2 legislation received royal assent on 10th of December 2024. The subordinated legislation, the rules which governs how you perform the Pillar 2 calculations, that got registered just before Christmas. So what does that mean? That means that as at 31 December 2024, the rules are fully enacted. What does that in turn mean is that WSB 112 requires reporting entities to account for current taxes under Pillar 2. So that is why, regardless of whether or not you have top-up tax in Australia, auditors are requesting for an analysis demonstrating whether or not you have top-up tax under Pillar 2. And this analysis typically comes in the form of a transitional CBTR, safe harbor analysis or modeling. What about deferred tax of Pillar 2? Due to the lack of consensus as to how you would account for deferred taxes under Pillar 2, there is a mandatory temporary exception from recognizing deferred tax assets and liabilities out of Pillar 2. There is no sunset date yet, so you can continue to apply the exception until you are told otherwise. If you're required to note in your financial statements, probably in the policy section, that you are relying on this exception. As an update, on 15 January 2025, OECD released further guidance on Pillar 2. The most important aspect of this guidance relates to deferred tax assets, particularly Article 9.1 of the rules. Now, to set things into context, right? Your Article 9.1 allows you to recognize a deferred tax asset at the beginning of the year. Now, you know what happens to deferred tax asset when it reverses? It goes into income tax expense, right? So it debits income tax expense, your effective tax rate goes up. So what appears to be happening is that MME groups are entering into new arrangements with certain countries to generate deferred tax assets that would reverse when Pillar 2 becomes operational and therefore shield the group from top-up taxes. So this new guidance says DTAs arising from arrangements with general governments, which gives rise to tax credits and other reliefs, cannot be taken into account. All right, and this includes when you're performing your transitional CBCR safe harbor calculations. And the DTAs that are caught are those arising after 30th November 2021 and specifically targeted, as I said, those relating to tax credits or reliefs, election or choice, which retroactively changes the tax position of the entity, or tax basis step up in countries enacting a new corporate tax regime. So you can see tax havens introducing a new 15% corporate tax rate for groups subjected to Pillar 2. So what are the recommendations I'm giving to my clients? If most groups are relying on the transitional CBCR safe harbor, right? I see no reason why you would not rely on this safe harbor for the countries which can satisfy the requirements. Why? Top-up tax is deemed to be zero for that country. You avoid the complex Pillar 2 calculations, and it is very complex. And thirdly, the amount of data you fill into your global information return is substantively reduced. Important thing that you need to note is that to use this safe harbor, your CBCR needs to be qualified. This is a new term in Pillar 2, right? To be qualifying, it must be based on qualifying financial statements. So for most of you, it would be the consolidated financial statements of the ultimate parent entity. So CBCR must be based on those qualifying financial statements, and that you must not make any adjustments between here to here, right? And you should be reconciling these two things to make sure that you can rely on the safe harbor, because if you can't, it is indeed a real nightmare. Also consider Also consider the lodgement requirements for all jurisdictions and whether or not you require software to meet your lodgement obligations. So in Australia, SW, we are developing software to lodge the Pillar 2 forms, including the Global Information Return in Australia. Now, the Pillar 2 calculation, the transitional CBCR safe harbor, is a simple calculation. It makes your life a lot easier for the first 3 years. But use that time because the transitional period will end and you need to perform the full Pillar 2 calculation. So use this period to prepare for when you need to perform the full calculations, including where you get the data from, how do you automate it, how do you check and the processes and controls around this. Also, for 2025, you need to prepare for the under-tax profits rule. So your auditors will come to you and they'll say, hey, prove to me that you in Australia are not subject to top-up tax of all your other group entities all around the world. So you need to provide that evidence that this UTPR is not triggered. So you need to prepare for this.